Welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Eric Dhall.
Hey.
Eric, it's 10 a.m. Pacific time here on January 24th. Ryan Kimmel and I were speaking this morning, and even though this month seems to be an excruciatingly long month, the last week of the month is next week. It's kind of snuck up on me.
Yeah, this has been a pretty brutal month, especially for those of us living in Southern California. But, maybe the year we won't need a refund on 2025.
Hopefully not. All right. It was a short week and a pretty quiet week, but let's get into the where are we for the week. S&P as of time of recording is up almost 2% on the short week here. Tech and communication services kind of leading the way. Comm services up 3%, tech up 2.5%. Oh, and I see healthcare up also 3%. So those are kind of your big winners. The only loser is energy, down 2.5%. A lot of that's on the talk of President Trump asking for lower oil prices. Seemed to move markets a little bit yesterday, but energy down at 2.5% on the week here. If we kind of look at the Russell 1000, or let's go back to month to date. So month to date, S&P is up almost 4%. The lone loser is consumer staples down 1%. And it looks like the big winner is industrials up 7.3%, followed by energy up 7%. And on a month to date, year to date, quarter to date basis. On the week though, Russell 1000 up 2%, Russell 2000 up 185. So pretty close there between large and small caps or small mid caps. Growth up 2.5%, outperforming the value up only 1.5% there on the week. And then to round it out, the S&P equal weight up 1.35% as of time of recording on the week, still up 420 on the month to date basis. So kind of this week was a kind of a repeat of what we saw in 2024 with tech and consumer communication services outperforming. A quiet week on the Treasury or the bond market side of things. Looking at the across the curve, the Treasury curve, the 2-year was the big market mover, down 3 basis points. 10-year was down a bip on the week earlier, but now it's down. Now it's flat. Third long bond also flat. So the 10-year's at 462, 2 years at 426 there. So curve still positively sloped there, and 2 10s at 36 basis points, and the 3-month 10-year at 31 basis points. So those recession signals continue to signal positive, some time for a recession. If we do look at the, as I said, quiet week, the maximum day of market movement in the 10-year was on Tuesday, down 5 basis points. Then you got a 4 basis point retracement on Wednesday. So not much movement there from the fixed income side, but a little bit of a positive market movement. Earn that carry. Ag up 14 basis points on the week. Looks like the investment grade corporate bonds up 20 was the big winner. Agency mortgages up 10, the loser out of the 3 sectors, with government's treasuries coming right in the middle there, about 15 basis points. High yield up 40, bank loans up 20, and emerging markets up 30. So positive green across the board there for the fixed income side of things. If we slip over to commodities, commodities were down, as you would kind of expect. They're down given energy equities down. Bloomberg Commodity Index down 36 basis points. Energy, the big loser, down 2.7%, so call it 2.75%. Industrial metals down 2%, while ags, precious metals, and livestock both positive, or all 3 positive on the week there. As I said, crude oil down 3.75% all week. Looking right now at 74.40, so a pretty big move there for oil. Still up 4.7% on a month-to-date basis. Copper up 7.6% month-to-date, but down 1% a week. So kind of a little bit of a reversal there. And they kind of rounded out. Gold up 1.2%. Right now it's at 27.78. So with that, Eric, that's kind of the market wrap up there. Short, quiet week. Why don't you go right into the macro side of things?
Yeah, definitely. As most of our listeners are aware, I would say the biggest market moving macro event was the change of administrations in the United States, which occurred on MLK Day on Monday. we had a changing of the guard, so to speak, and a flurry of executive orders unleashed that has really shaken things up, to say the least. I think you saw that big move in the dollar down because the expected day one tariffs failed to materialize. So that was something quite interesting. A lot of FX traders are licking their wounds. They were expecting the dollar to rally on huge day one tariffs, which didn't occur. And it looks like a lot of the campaign tariff talk is maybe a negotiating cudgel rather than just instantaneous implementation. So we'll see what happens, but there's just a lot to process and a lot going on.
Yeah, I did think it was interesting. Ken Shinoda was on our TV today, and I'm sure that interview will be up on our YouTube channel here early next week. But all the questions were around Trump and what are the expectations and what kind of how are we reacting to what the Trump administration is doing. So that's certainly top of mind and something that we wouldn't see in the macro data points. But certainly you're right, Eric. That is kind of the big market moving events that are going on.
Yeah, so kind of bringing it back to the more traditional macro events. Wednesday, we got LEI, and it came in at negative 0.1%. The estimate was negative 0.1%. The prior was positive 0.4. I'm kind of I'm not a big I don't put a lot of trust in the LEI these days. It's just it's done pretty poorly, and it is kind of signaling maybe we're in the warning zone for a recession, but it's been saying that for a long time, so can't really get too excited there. On Thursday, we got the initial jobless claims for the week ending January 18th, and they were up 3,000 to 223K. We haven't really seen the full impact of the California wildfires yet. You might expect to see that number bump up a little bit going forward, but just a little bump up there. But the continuing claims came in pretty weak at 1,899,000, up 33K, and that leaves it close to its 3-year high, let's call it. So definitely at the high end of the range, and maybe we'll start seeing some spillover from the disasters there. So keep an eye on that. And then Friday, we got the S&P Global U.S. Manufacturing PMI, the January preliminary. That came in at 50.1, which was above the estimate and above the prior. So positive news there. When you kind of dig down in the S&P Global U.S. Services PMI, it came in at 52.8, which was a miss to the downside and below the prior. So a bit of a miss there. And then you look at the composite level, it came in at 52.4, again, a miss to the downside and below the prior 55.4. So I think that, there's definitely, if you're looking for maybe something negative, that there's something to be gleaned there. But I think there's so much going on with the changing of the guard in Washington and this kind of new era that we're in. I think we just have to wait and see how things evolve over the next month or two.
Yeah, certainly you could see that conceivably the manufacturing numbers are higher because people were trying to get things done ahead of the as you mentioned, Eric, the proposed tariffs or the expected tariffs. And so we'll have to see whether that manufacturing number continues at an above 50 pace or kind of dies back down to kind of what we've seen as a kind of more normal level given the current environment of the manufacturing sector.
Yeah, and that kind of wraps us up on the week. It was a short week. Maybe let's talk about the interest rate probability.
Yeah, the Fed, there is the Fed on Wednesday. We're looking at a 0.5% chance of a cut. So certainly the market expects nothing doing. We're up to 1.75 cuts priced in for 2025, though, with the first cut priced in for June. So kind of wait and see where the data takes us, where the data takes the Fed, and really look and see how things shake out from here. With that, next week is a pretty busy week as we kind of round out the end of January. We got durable goods orders and cap goods orders on Tuesday. Durable goods, this is the December preliminary numbers. Durable goods expected to be 0.8, up from a negative 1.2 last month. Transportation up 0.4, up from a negative 0.2 last month. We also get the home price index, the S&P CoreLogic Case-Shiller 20-city home price index is expected to be up 0.3%, kind of in line with last month. That would kind of last year over year. That last month was 4.2, so kind of expect in that realm of things. As Wednesday, we do get the FOMC rate decision, so make sure to Jeffrey Dunlap will be on CNBC to talk about the Fed and what Jay Powell is doing right or wrong. And then Thursday, we get the GDP number, the fourth quarter advanced estimate. This is our first look at fourth quarter GDP. Expected to be 2.6%, so down from that 3.1% from the third quarter, but really kind of wait and see what that shakes out to be for the fourth quarter. Still very strong at 2.6. Thursday, we also get the jobless claims data. As Mark showed last week, no estimates out yet. And then on Friday, we get the big data dump at the end of the month. The employment cost index comes out. That's expected to be 1.0, up from a 0.8 last quarter. So it's a pretty strong number there. So we'll see whether the Fed whether Jay Powell gets the early look on that number, and whether the Fed starts worrying about wages increasing at a much higher rate than they would want. We also got personal income and personal spending. Income expected to be 0.4, down from 0.5. Spending the vice versa, expected to be 0.5, up from 0.4 there. And then finally, we round out with the Fed's preferred inflation gauge, the PCE price index comes out. The headline number expected to be 0.3, up from 0.1. Core PCE expected to be 0.2, up from 0.1. Now, if those shake out, the headline PCE will be 2.5, up from 2.4, and core PCE still at 2.8 flat. So maybe not the progress the Fed's expecting, but 2.8, I'd say, that's a two handle. Not necessarily going in the right direction there, but certainly it's not going in the wrong direction. So maybe that's why the Fed's on hold, see whether that number comes down or whether that number goes up, and they have to consider hiking rates to kind of get that under control. But right now, nothing doing. If everything kind of comes on as expected, I think that it should be a pretty quiet week. Let's knock on wood here to make sure that doesn't happen.
Yeah, I mean, we'll see what happens, but definitely all is in the Fed. I'm pretty curious to see how Jay Powell handles the kind of verbal jousting he's going to be engaged with Trump. Was virtually at Davos saying Jay Powell needs to cut interest rates, and he thinks he knows more than him. So, I mean, it's kind of a ridiculous scenario, but hey, this is the world Jay's living in, and I'm curious to see how he navigates it.
Well, certainly, I would say that President Trump has more experience taking out loans and worrying about loan interest rates, not necessarily Fed funds rates, but certainly maybe interest rates overall.
He definitely understands the impact of rates on the commercial real estate business. With that said, I think that wraps it up for the week.
That's right. I'd like to thank all our listeners out there. Don't forget, you can check us out at DoubleLine.com. YouTube channel is youtube.com/DoubleLine Capital. We have all three pieces of the Roundtable Prime up. I listened to the last one or watched the last one this morning. So those are definitely worth your time. Get some good ideas, good macro landscape, and kind of talk about markets and macro from a broad perspective from a bunch of different people. So definitely worth a listen there. And I'm sure we'll have Ken's Bloomberg interview up on the YouTube shortly there also. So with that, I'd like to thank everyone for tuning in and hope everyone has a great weekend.